it's Jack here from System Trader, and in this long session I'm going to talk about building and testing ETF portfolio, and that's gonna be a pretty long session. I think it will take well beyond 1 hour. So let's get started and let's talk a bit more about who am I. So for those who don't know who am I and why I'm here talking to you today. In the meantime, also, I would be very grateful if you can write in the comment, if you can hear me and see me, because that's quite helpful in terms of proceeding further. But okay, who am I? So I'm a software engineer. And because I'm a software engineer, I'm also very much interested about investing using some systematic approach. And I am developing also software which is going to support investors. And apart from being a software engineer as my profession, I'm also a blogger and podcaster, and I'm running a System Trader show. This is a podcast where I try to reach people who are highly acclaimed and recognized in industry area. Thank you, George. Voice and video is okay, so that means that we can proceed. Thank you. Apart from being a blogger and podcaster, I'm also obviously managing my own portfolio. I'm individual investor, and for your information, I'm located in Belgium, in Brussels. Maybe I will make this presentation a bit bigger so that you can see it better. And also today, some of you can watch it, but if you cannot participate throughout the whole session, the video will be also available later for you, and also there will be a podcast episode made from that material, so that if you cannot be with me for the whole time during today's session, you can go back to the material later and see it, or even hear the podcast. And some short disclaimer. I do not provide investment advices. So I have obviously some investment experience and I have some knowledge, and I try to share my knowledge with you. And as I said, because I'm a software engineer also, I'm creating tools which are supporting independent investing. So for all those who are trying to invest on their own, if you want to manage your own portfolio, then you may be interested in the software I'm preparing for you, because this is helping you to do your homework. But okay, I think that after today's session, you will have a better understanding what I'm talking about. And by the way, investment advice is definitely something more than just education or selling a product. Today, I will be mostly talking to you and you will be listening. And whereas if we are talking about the investment advice, in fact, we should, as an advisor, hear the second, the people sitting opposite us, and we have to know exactly their situation, and then only we can provide them some advice. And this is not my role today. I'm not giving you any advice. I'm trying to share my knowledge, and I will give you some tools, but you have to do your homework on your own. Okay, so what I'm going to talk about today. As I said, it's going to be pretty long and extensive session. So please see it as an introduction to the topic. And so see it as a basics of investing with the use of ETFs. So I will talk about the philosophy, strategy, and discipline, which is a kind of a recipe for investing. Then I will talk a bit about let's say the major distinction between two approaches, passive and active investing, because if you want to invest, you have to have your own philosophy on top of which you will build the strategy, and later on you will follow it. I will also explain ETFs. What is an ETF, exchange traded fund? Because this is a building block for the strategies which we will build and and test later on. So therefore, you have to understand what that instrument is. And I will try to help you what to look for when choosing ETF for to your portfolio. And also, I will explain quickly how to buy and what you need to check first before buying it. I will also provide some basics about the asset classes, and you don't have to be worried now if you don't understand what I'm talking about now, because I think that after that session everything will be clear. And I will also introduce you to the world stock indices, because when we are trying to invest, I will explain you why it's good to do it globally. And to do so, you have to understand how the global markets are divided. You have to know the major stock indices which are on that market. And I will also mention about how you can possibly improve your results using so-called factors. That was the theoretical part. There will be also some practical exercise in which I will show you how to backtest some sample portfolio in my software, and I will show you the simulation in the phase of accumulation. So when we are younger, when we are building our capital, and then the phase of consumption when we have that capital from which we want to live. I will also mention about the currency risk, because if you are especially investing globally, then it means that you are exposed to different currencies. So there is some risk, and it's good to understand that risk and measure that risk. And if there will be any questions, I will also answer them. And as I said, this is an introduction. Although it will be quite lengthy, it's still an introduction. But I think it's a good basis for further work and further sessions. So if you are interested, I can provide you in the subsequent sessions some more hands-on how to build step-by-step sample portfolios. And also, I would like to mention about some active strategies, because today I will be talking about passive approach mainly, but there is also active approach. And especially I like very much the momentum, so-called momentum approach, momentum anomaly. And there is a strategy, for example, like global equities momentum, which was introduced by Gary Antonassi. It is an expert in the momentum area, and he showed us that, to the world, he showed that strategy, how simply using momentum on indices can be really a game changer when it comes to investing. But okay, let's say that this is a bit more advanced topic, so I will only mention about this today, and I will not go any further into the details. So let's get started now. You may ask why we even need to invest, and the short answer is that you have no choice. You have to invest your money. And why? Because without investing, you will not keep the current value of your money, because there is something like inflation. So if you put your money under the mattress, then basically each year the value of your money there will decrease. Therefore, you have to invest that money. So if you are afraid of investing because there is a risk, and indeed there is always a risk, but not investing is also a risk, because you will certainly lose the value of your money. Therefore, if you want to keep the value of your money, and even if you want to make it better, to make more money, then you have to invest. But just to be clear, investing is not a shortcut to earning quick money. So if you are having some trouble with your money, your salary maybe is not good enough, then investing is not a good way to go. We are investing only the surpluses. But okay, I will talk about this a bit in a while, because you should take care of your personal finances first. So if your personal finances are not healthy, then you should not think about investing. And as I mentioned, there is no profit without risk. Obviously, everywhere is risk. And the risk is even needed because without risk, we could not, we would not have even chance to capture the premia for taking risk. So the risk itself is not a bad thing, but we have to understand the risk and we have to understand how much risk we can take. And when we are talking about investing, and I think that after today's session, it's very important to have realistic expectations. People are trying to invest without having any healthy expectations, which is a recipe to disaster. And discipline, that's another thing which is very, very important. And sometimes we are looking for great solutions, great strategies. And we think that once we have such strategy, everything's done and we will be rich very soon. But that's not the case, because actually coming up with a good strategy is not a big problem, because there are ready solutions to be used already. You don't have to reinvent the wheel, but it's very difficult to follow any strategy with discipline. And this is really tricky. And also I will talk about this later in this session. And lastly, last but not least, don't expect immediate results. Even if you are following a strategy which is a profitable strategy, that doesn't mean that you will have immediate positive results. It may happen that it takes time until you will see such results. And it also may happen that for some time you will even be losing. So you have to be prepared. You have to understand what you are doing and why you are doing things. I had on my podcast Rick Ferry, which is a known expert in the so-called bogleheads area, people who are following the Jack Bogle philosophy about passive investing. And he mentioned that every investor should think about investing like there are three pillars. And the first pillar is philosophy. The second one is strategy, and the third one is discipline. So the philosophy is just, as the name says, it's just a philosophy in which we believe. For example, we may believe that the only way to go when it comes to investing is a passive investing, so that we don't try to beat the market. We just rather than looking for a needle in a haystack, we just buy the whole haystack, as Jack Bogle says, which means that we just buy the whole market, the whole index there, and then we just keep in our portfolio, and we don't do anything with it. We don't try to time the market. So this is just a philosophy. It doesn't mean that this is the only philosophy, because I'm not dogmatic, and I also believe that we can invest actively, and I have a good proofs that it's possible. But if you are trying to think about simplicity, the passive investing is one way to go, and that's a good philosophy for sure. And today I will talk mostly about that philosophy. Once we have philosophy, on top of that, we have to build a strategy. So that's a implementation of a specific steps which are trying to make that philosophy working for us. So on top of philosophy, we just implement a certain strategy. And once we have strategy, we have to be very disciplined in following that strategy. And as I said already, discipline in these three pillars is the most difficult part of investing. And as I said, Rick Ferry, I had him on my show. It's the episode number 18, and he was saying there about why should most investors invest passively. And Rick Ferry is, as I said, a very well-known person in the investment industry for years, and I highly recommend to listen to that episode. So let's start with this first pillar, the investment philosophy. As I said, today I will be talking mostly about the passive approach, but I will also mention a bit about the active, just to highlight the differences between these two approaches. So the passive portfolio, I think it's highly recommended for most of the investors because it's very simple. You just buy something which is very well diversified, and you just hold it. So although it seems easy, and technically it is easy, still from a psychological reasons, it's not that simple. But this is a great, I think, advantage of that approach, that at least technically you cannot break almost anything because you just buy something and hold it, and that's it. So there is no risk that you found something in the data, for example, or that you are trying to time the market without any strategy and that you will be beaten by the market, because here you just buy the whole market and you hold it. Once you have that portfolio, you have to do so-called rebalancing, because probably you don't have only a single thing in your portfolio, but you have multiple elements in your portfolio. So therefore, from time to time, you have to do so-called rebalancing, and I will be talking about this today later on. And as I said, usually there is no attempt to beat the market when we are talking about the passive portfolio, but sometimes, in fact, we are also trying to beat the market, because although the facade is passive, behind we are having instruments like, for example, active ETFs, which are in fact active strategies. The good thing about passive portfolio is that it's really cheap, and you cannot control, for example, markets, but you can control costs. So if you can make costs low, it's a good way to go, because that's a guaranteed advantage. And the very good advantage of passive portfolio is that it's very cheap. And another good thing about passive portfolio is that it's also not requiring us to spend a lot of time to manage such portfolio, because basically, even if we do it on, just ourselves, it's just a few minutes a year enough to manage such portfolio. And as I said, there is a guarantee of investment result, meaning that we will not be beaten by the market because we are buying the whole market. So you will not have the chance to beat the market, but at least you have a chance, and very high chance, that you will not be beaten by the market. And the best approach, or the best instrument to build such portfolio, the passive portfolio, is to use instruments like ETFs, exchange traded funds, but also you can think about index funds and robo-advisors. Today, I will talk mostly about ETFs, and I will explain more how this instrument works. The robo-advisor is a tool. I think it's a kind of a service rather even than a tool, which is doing everything for you. But this session is for people who want to do it on their own. So if you don't want to delegate your work to anyone else, you want to do it yourself. And the active portfolio, on the other hand, because I already mentioned what the passive portfolio is, the active portfolio is kind of a portfolio where we try to be smarter, let's say, than the market. So, for example, the allocation in the portfolio may change in response to market changes. So, for example, if the market goes up, the stock market, we are trying to have stocks in our portfolio, whereas when the market is going down, then we, in response, for example, we put bonds to our portfolio to be safer. Obviously, it's not that easy as it sounds, because if that would be so easy, everyone would be doing that successfully, whereas that's not the case. But it is possible, and there are great strategies to do it, which can do it. And as I said, Global Equities Momentum, introduced by Gary Antonassi. This is my favorite, and I highly recommend to read Gary Antonassi book, Dual Momentum Investing, because this is a great approach. But as I said, this is, let's say, a bit more advanced topic, and today I will focus on passive approach. And why someone would like to have an active portfolio rather than passive. The goals may be various. For example, indeed, someone wants to beat the market. So he wants to do it actively because he or she wants to have a higher profit. But there may be also another reason. For example, we want to have less volatility, or maybe someone wants to have dividends, and that's why he's focusing on active strategies. But as I said, the result of the investment is not guaranteed. And by the way, in investing, nothing is guaranteed because there is always a risk. And the only thing we can do is to try to estimate that risk, but the risk is always. The active approach may require a bit more time commitment from us. That doesn't mean that we have to spend hours daily on running such a portfolio, but it may require us a bit more understanding and a bit more time commitment. Although again, the global equities momentum, which I mentioned before, because I really like it, is not requiring us to spend hours on it. It's just, I think, the same time commitment as for the passive approach, whereas we have active. And the same story as with passive. In active approach, we can use ETFs, but we can also use stocks, derivatives like options contracts, futures contracts, I mean. But today we are talking about passive portfolios. So that's it for today for the active approach. How do the active managers do? And why that idea about being passive is so popular? And I think that one answer is just on that slide which I'm showing. And if you are just listening and you don't see the slide, then I will explain you. Here we have the percentage of European equity funds which were outperformed by benchmarks. And for example, in Europe in 2020, there were funds which were trying to invest globally in an active approach. And imagine that after the 1 year, only over 50%, exactly 54% of funds in Europe, which were investing globally in an active manner, were beaten by a simple index, S&P Global 1200. It's a simple index which is just having 1,200 companies globally. And after first year in Europe, 54% of the funds trying to be smarter than the market were actually beaten by that market. But that was just the first year. After 3 years, it gets even worse because 81% of the funds, actively managed funds, were beaten by such simple index. After 5 years, it's even worse because 90% of the funds were beaten. And after 10 years, 97% of the funds were beaten by S&P Global 1200. So imagine if you would like to choose the active manager to manage your money, how do you want to pick the one which will beat the market when 97% of them are beaten by the market after 10 years? So in fact, that's the answer why people are going passive, because at least they know that they will not be beaten by the market. And in fact, by resigning from trying to beat the market, they have almost guarantee that they will have a better performance than the 97% of the actively managed funds. This is of course one example of one funds group, but basically similar scorecards are made on other markets as well, and the conclusion is very similar. The active managers are doing poorly, and not only just because they are not so smart to beat the market, but because also the costs are involved in running such funds. And it's very hard to, when you include these fees, to, on top of these fees, to beat the market. And in fact, most of them are after fees below the market. So that's the good answer why we want to think about passive approach. So let's talk about the strategy. And why were ETFs invented? So as I said, the actively managed mutual funds are failing and most are beaten by the market. And as I mentioned, for the reason is just the fees, the costs, but also the psychology. We are just human beings, and it's not that easy to beat other market participants as we think. Obviously, we are typically overconfident and we think that we are a better version of ourselves, but in fact, it's very hard to beat and to repeat it again and again, the market. So because of that, that was one of the reasons why ETFs were invented. And by the way, before exchange traded funds were introduced, and the first one was introduced, I believe, in 1993, or even in 1992 in Canada, and then in 1993 in United States for S&P 500 SPY. In the mid of 70s, there were index funds, and there are still index funds. And the main difference between index funds and ETFs is that the index fund is not listed on the stock exchange, whereas the ETF, you can look at this like it's a index fund, but which is available to buy and sell on the stock exchange as, for example, equities. And so it's just a different, let's say, venue on which you can buy it. It's easier to buy, it's easier to trade, let's say. But basically, the idea behind originally was the same. As the name says, index fund means that there is an index, and that fund is trying to follow that index. And I will talk about this later. So, as we know, and I will show that later as well, stock market beats inflation in the long term, and also active managers are doing poorly. Therefore, in the passive approach, we let the market do the job, and for that, ETFs are very helpful because buying just one ETF, we can even cover the whole world, the whole market globally. And the great thing about ETFs is that it's almost free. And by the way, sorry for the typo here. I see I put here, I forgot L letter, but it's almost free. And sometimes annual fee for ETF is less than 0.1%. Imagine that. So it's really, really almost free. And although ETFs are so great, you have to remember that it's just a tool. So many investors which buy active funds, which are already underperforming, but even these investors buying these funds are doing even worse than these funds, meaning that people who are buying active funds are trying to be smarter, and they think that they will buy them on the bottom and sell them on the top, whereas it's typically the opposite what is in reality. So therefore, even if the active fund is doing worse than the market on average, the investor who is buying such a fund is doing even worse. But the same story is with ETFs, unfortunately. If you have an ETF for, let's say, S&P 500 index, and that index, 500 biggest American companies, is doing great for decades, the average investor who's buying such ETF or index fund, which is replicating such index, is unfortunately having a worse result just because he's trying to, again, be smarter than the market. And again, the same story as with the active funds. Therefore, remember, it's a great tool, but it's just a tool. And the source of the problem for any investor, no matter if it's active or passive, is that many investors, they don't have any kind of strategy. So this is a disaster, because if you are trying to invest without having any kind of strategy, verified strategy, then obviously you cannot expect miracles. And another problem is that there is a huge problem with discipline. And the lack of discipline in following the strategy is also a recipe for a disaster, because even if you have a great strategy, but you will not stick with it, then you will have problems at some point. And ETF is just a packaging only. I'm talking a lot of ETFs, exchange traded funds today, but you don't have to look at it as it's a magic pill to solve all the issues. It's just a tool, and it's a packaging, which is a kind of a wrapper around other things. And a very important thing about ETFs is that it's a fund which is listed on the stock exchange. I mentioned that already, so that you can easily trade it. You can easily buy it once you have access to the stock exchange. Once you have a brokerage account, then you don't have to actually during the session you can buy and sell ETFs. And ETF may replicate indices like, as I mentioned, S&P 500, for example, but also it's not only that we have to focus and we only have ETFs for stocks, for equities, but we can also have ETFs giving us exposure to commodities, bonds, real estate, and so on. So basically, there's an ETF for anything you can imagine. And even you can have an active strategy underneath. So although typically ETFs are linked to passive approach, in fact, ETF may also be an active strategy underneath. So as I said, it's just a wrapper. So therefore, even buying an ETF, you have to understand what you are doing. And I will show you that later today. And it's important to understand that because ETF is just a building block for our strategy, which we will try to build and implement and follow. But there is a problem, because we can say that there is a curse of choice, because there are almost 10,000 ETFs worldwide, whereas typically you need 1 to 10, let's say, ETFs to construct a good portfolio. And how to choose just a few ETFs when there are thousands of them? So I think that you will find a solution for that also today. And to make it even worse, the same ETF may be listed on several exchanges, or the ETF for S&P 500 may be from many different providers, and it may be in different stock exchanges, in different currencies, and that's making a huge problem for investors who are trying to make the first portfolio, because they are really lost in that huge world. And I will try to help you today. Building a portfolio, I think it's good to look at it. It's like cooking. So you have a lot of these different bits, different ingredients, like you have flour, baking soda, sugar, eggs, milk, and so on. And you just take these ingredients and you try to make and you try to cook something. And obviously there are different flavors and there are different preferences. Therefore, our portfolio should also be adjusted to our preferences. And when I'm talking about cooking, you can look at the asset allocation of our portfolio the same way, but instead of flour, baking soda, sugar, and eggs, you put a different asset classes like stocks, bonds, real assets in different ratios. And the most important part from that is you don't have to be worried what proportion of your portfolio will be in the end, unless you will not try to mess with all the ingredients while they are cooking. So because then it's a recipe for disaster for sure. So you have to come up with a portfolio which is well adjusted to your preferences. But once you have that portfolio, don't mess with it. Just you have to imagine if you are cooking and you would try to manipulate with what is being cooked, then you will have a problem. The same is with the investing. You have to come up with your portfolio, and then you have to just follow your strategy without trying to change it constantly. So you have to do your homework, definitely. So now I will talk a bit more now about ETF, how it look inside, how to understand the ETF. And here I put some example of an ETF which is coming from from Nasdaq exchange in United States, and it's an ETF which is replicating MSCI All Country World Index. So basically, in that ETF, you have a global exposure to the stock market. And as we can see here, for example, this is there are some key facts about such ETF. The net assets of that portfolio are 16 billions of dollars. It's listed on Nasdaq, and for example, there are over 2,000 companies in that ETF. So imagine just buying a single ETF. You have already exposure to the whole world, and you have like you would buy by yourself over 2,000 companies globally, but you don't have to do it because that would be very difficult to do so. Imagine how much capital you would need to have, and how time-consuming and expensive job that would be to replicate globally the whole market. And now just buying one ETF, which will take you a few seconds, you have global exposure to the whole global market. That's really great. So, some advantages of ETFs. Let's make some conclusions out of what I already said. So, low costs, and it may be really a great difference if you compare it to active approach, active strategies, mutual funds, because the mutual fund can charge you like 1-2% depending on the country, or even more than 2%. Whereas like here, that particular ETF is charging, I don't know if there are costs here on that screen, but basically it will charge you probably something like 0.2% per year. So like 5-10 times cheaper than active funds. It's very transparent. ETFs are very transparent because you have insight into portfolio composition, and you have a clear investment policy, and you see the pricing in real time on the market. It's also very liquid because even if you are buying an ETF, that doesn't mean that the real stocks had to be at that moment bought or sold if you are selling, because you may exchange ETFs between other market participants, which is very great because in fact that means that that's the way how to lower the costs, because rather than make the real transactions on the market buying certain stocks, you are just exchanging ETFs between market participants. Of course, if there will be a higher demand to buy something, then we will have to reach the real market, meaning that we will have to buy or sell something on the market, meaning stocks, for example. But even over 90% of the transactions are not touching the market as such, because over 90% of the transactions, it's just a simply exchange between other market participants. And ETF is also giving us a broad diversification. Really, as I showed you, just buying one ETF, you have the exposure to the whole world, and it's so simple. And also it may be very tax efficient, depending again on the country, because it varies between countries. But imagine that you have a multi-asset ETF, for example. So that in one ETF you have stocks and you have bonds, and everything is done under the hood. And even if there is so-called rebalancing, something is sold or bought under the hood just to make the model portfolio aligned, you don't have to pay any taxes because that's done within the fund. Sometimes it's also tax efficient because it can accumulate dividends. Again, not everywhere, but for example, in Europe, ETFs can be in so-called accumulating mode. So that means that they are not distributing the dividends, but they are just reinvesting them within the fund. And in some countries, because of that, you don't have to pay tax for the dividend which was shown at that moment. So where we can buy ETFs, for that we need a brokerage account. So that's, I think, let's say, a difficulty, because it sounds like something strange or something difficult, whereas I think it's not the case at all. And I think it's worth to do it, because by having the access to the market, you can really very cheaply have an exposure to the markets. So you don't have to pay extra money to any other services, funds, or whatever. You can do it on your own, but you need to have the brokerage account. And as usual, pay attention to costs and taxes. And it's hard to discuss it today on the topic, because that's really very depending on where you are located. And for example, in Europe, if someone is in Europe, most likely such investor will not have access to ETFs which are listed in United States, because the regulator takes care of us and he wants to protect us. And sometimes it's a kind of a protection where, in fact, we are cut off from the best ETFs which are listed in United States, for example. But okay, I don't want to go too much into the details today. But for those who are in Europe, most likely you will not have access to US listed ETFs. And taxes, wherever possible, use tax-free accounts. So if in your country there is a kind of a retirement plan, a retirement account on which you can invest money without paying taxes, or if you can defer or delay your tax payment, it's worth to do it, because even delaying your tax payment, it's like a free loan. So Rob Arnott from Research Affiliate, he called that as a tax alpha. So as I said, you cannot control market, but you can control costs, and to some extent you can control taxes. And it's worth to do it, because rather than from the beginning start to beat the market, you should be you should control what you can control, like costs and taxes. So therefore you should consult your local tax law. And as I mentioned already, in some countries, for example, it's good to have so-called accumulating ETFs, because when the dividend is paid out, there are high taxes. But okay, again, I will not go into the details here. And I think that this is interesting mostly for those who are investing in Europe. So once you have an ETF, and you know that, for example, you need to buy an ETF for, let's say, S&P 500 index, what you should look at. And I will show you two screens from two different, let's say, services where you can find ETFs. The first one is for European investors, just ETF and .com. And what you should look at. First of all, the fund size. The bigger the ETF is, the better, because that means that there is a less likelihood that that fund will be closed. And by the way, even if ETF is closed and you have money invested in that ETF, that doesn't mean that your money are lost. But obviously, the bigger the ETF is, the better for us. Replication, that means that if it says that it's a physical replication, that means that, and again, this is mostly in Europe, because in the United States, most of ETFs are physically replicated. But in Europe, you may find that although you have an ETF for, let's say, S&P 500, under the hood, you don't have really the equities, the stocks, the companies from the S&P 500, because it's so-called synthetic replication, doing some engineering, financial engineering magic to make it replicating S&P 500. So again, know what you're doing and what you're buying, because if for some reason you don't want to have a synthetic replication, for example, you should check it before buying such ETF. The fund currency, again, that's telling us in which currency the fund is run. And for example, here we see that there is a currency risk because there is no hedge. So again, if you are, for example, in Europe and you are living in Eurozone, then you have exposure to American dollar, and that means that there is a risk, currency risk. There are ETFs which are hedged, but for that protection you have to pay extra money as well. There are fees, for example, like in that example, we have 0.07% per annum, which is very low. And let's take another example. That's an American ETF listed on the American Stock Exchange, the SPY, State Street Global Advisors, that's the issuer, SPDR, that's the brand. It was incepted in 1993, and we see the expense ratio, the fee is 0.09%. So basically, more or less similar information as we saw before. And now the question which quite often comes up: will ETFs kill the market? Because imagine if everyone would think that, okay, I'm not going to beat the market, I want to invest passively. What will happen then? I mean, how the market will work if everyone would start invest passively, buying the whole market without trying to beat the market? So I think that this is a kind of a philosophical question, because it's hard to imagine that everyone indeed would invest passively, because there will be always a number of participants on the market who are trying to beat that market. But once we indeed would have more and more passive investors, that the market would not do their job, meaning that the market is to evaluate the price of assets. And once that mechanism would stop working correctly, that means that there would be some inefficiencies on the market. And then again, people who are trying to beat the market would take the opportunity and they would like to beat that market. So I think that it's very unlikely that everyone or most of us will invest passively, because there will always be a number of participants who are willing to beat the market. And by the way, ETFs, although there is more and more ETFs on the market, they are still making like 5% of the market volume in United States, for example. So that means that 95% of the transactions in United States are made by active participants. And it's because also of the fact that ETFs, even if you are buying or selling, as I said before, that doesn't mean that you are touching the market on the bottom, because you may just exchange the ETF with other investor. I see some questions coming up, and for sure I will answer them maybe later in the QA session. So for sure I will get back to that. So Octavian, just please wait a bit, and for sure I will look at it and I will answer them later on. Portfolio building blocks. I think that it's very important to understand the building blocks, how to build a portfolio, because without that understanding, we cannot really build any kind of strategy. So first, why we want to buy equities to our portfolio? And the answer is well presented on that screen. Where we see American stocks from the year 19 till the beginning of 2020. And over such a long period, equities in real terms were making like 6.6% per year. And real terms means after inflation or inflation adjusted. So imagine that today people are struggling to beat the inflation, whereas in the long term, equities, at least historically in United States, were beating inflation by over 6% per year. And as a comparison, the bills, which are kind of equivalents to bank deposits, were making 0.8% per year in the last 120 years in United States. So as I said, I will get back to the questions. So please, if you have any questions, you can put them and I will answer them in the QA session. So thank you for asking. And why we want to diversify our portfolio globally. So we know that we want to have stocks, equities in our portfolio, but why we want to diversify it globally? Why don't maybe we want to put maybe a few best companies, we think the best companies, and they should make us rich? Well, because stock picking is not that simple as it sounds. And not even that the company can be closed, but even the whole market can be closed or can be underwater, let's say, for a long time and very deeply underwater. And just a few examples. In 1949, in China, the stock market was closed, totally closed. So there is a loss, 100%. The money the investors had invested at the time on the stock market in China, they lost everything. Similar case, by the way, was in Russia during the so-called October Revolution, 1912, 1918. Again, the same story. I mean, the market was just closed. In Japan, for example, on the other hand, after the Second World War, when the stock market was opened, during the 1945, 1949, the loss of the stock exchange of the equities in Japan was 96%. Imagine that you have invested money and you are losing 96%. During the Great Depression in United States, during 1929, 1932, the markets went down by 85%. And Japan, again, in 1989, there was the end of a bubble and the problem with deflation, and the markets went down by 75%. And that magnitude of how deeply the market goes is not the only problem. The other problem is how long it takes to recover from such losses. And for example, in Japan, the bubble ended in 1989, but till today, 2021, the market is still underwater, meaning that if you would invest in 1989, most likely you will have less than you had in today. You will have less than in 1989. So that's really a disaster. Markets by capitalization. So again, I'd like to explain you how the global markets are divided, and we can see the two biggest chunks of the markets: the so-called developed markets, meaning the countries with the developed industries, and 86% of the capitalization, the value of the companies, are from that developed markets, whereas the other chunk, much smaller chunk of the markets globally, is coming from so-called emerging markets. It's 14%, and within that chunk, around 40% is just China. So almost half of emerging markets belongs to China. And by the way, the emerging markets, on the other hand, although the value of companies is around 14% globally, the world population in emerging markets, it's around 70%. Yeah. So I think that's it. And what the cap weighted index means, because I'm talking about the capitalization. And imagine that you have S&P 500 again, 500 biggest American companies. That doesn't mean that you have 500 companies and each company has equal weight in that index. In fact, it's not like that. The weight is dependent on the market value of the company. And for example, I just made that screenshot last night. If you take the top biggest companies from the S&P 500, you will see that, for example, Microsoft Corporation has 6% in the S&P 500. This is the biggest company in the S&P 500. The second biggest company is the Apple. Again, it has like 5.98%. The third one, Amazon, and then you have Google, Facebook, Tesla, and so on. But as you can see, the further we go, the value of the company or the weight in the index is smaller, and that's the nature of cap-weighted index. Emerging markets and developed markets. Again, now, as I said, 14% of the capitalization comes from the emerging markets, meaning that if you take all companies from the emerging markets, the value of these companies, it's about 14% of all global companies. But if you take another measure, GDP, then it means that, for example, emerging markets are having 43% in global GDP, which is more than capitalization. And the emerging markets, again, the biggest countries in emerging markets, as I said, almost 40% is China, 39.1 exactly on that picture from 2020, I believe. Then you have South Korea, 13%, Taiwan, 12%, India, 9%, Brazil, 5%. And the markets are not, it's not like they are made in the stone and it's fixed. Everything is changing. The world is changing. And for example, in 1899, the biggest markets in the world at the time are the countries which they are not that big when it comes to the size of a stock market. For example, in 1899, United Kingdom was having 24% of the market share globally. On the other hand, United States were having 15%, Germany 13%, France 11%. And if you look at what it's now in 2021, USA has now over 55% of the market share globally. Japan, they have 7%, China 5% globally, UK 4.1%. So imagine in 1899, United Kingdom was the biggest stock market in the world, almost, not almost, 24% globally, and today it's 4.1%. That's a huge change. That's how the world changed over a century. And now, very important slide, and for those who don't see the picture because they are listening, for example, to the podcast, I will just try to convince you to open your creativity and imagine, visualize what I'm talking about. The markets globally are divided into indices, and the top index is, for example, MSCI All Country World Index. I'm talking, for example, because there are certain number, there is more companies which are providing us with indexes. But MSCI is one of the major company which is providing the indexes, and in their hierarchy, MSCI All Country World Index is on the top, All Country World Index. Below you have smaller indexes. For example, you have MSCI World, which is all developed markets globally, and you have MSCI Emerging Markets. Then under the developed markets, you have Americas, Canada, United States, you have Europe, like Austria, Belgium, Denmark, and so on. You have Pacific, like Australia, Japan. And the same story for emerging markets. You have emerging markets as a whole, and then you can divide into a smaller indexes, like you have MSCI Argentina, MSCI Brazil, MSCI China, Chile, whatever. So why I'm talking about that here is that quite often when you are buying, when you are choosing or looking for an ETF, these ETFs are replicating these indices. So therefore you should know that if you are buying, let's say, MSCI World ETF, that means that it's not really a world. For historical reasons, it sounds like it's a world, but it's only the developed markets. So it's a global index, but only covering the countries with developed industries. So I think that's quite important to understand. How about other asset classes? So I talked about the equities. How about other asset classes? So again, I made a let's say a table on which I'm showing a different asset classes for the last 100 years, the returns. And as you can see, that the highest returns were for the equities, obviously. S&P 500, for example, in the last century, for the last 100 years, the annual return, real, meaning inflation adjusted, was around 7.5%. But the maximum drawdown, the maximum loss you would have to go through investing in such index is 83%, over 83%. On the other hand, you can see on that picture fixed income, which is not having such a severe maximum drawdowns, but it has a smaller return. So the risk and the volatility, it's a kind of a currency with which you pay for the returns. And the fixed income, the bonds, for example, they have lower volatility than equities, but there is a price for it. You have to expect lower returns. And for example, the 10-year government bonds in United States for the last 100 years, they were giving us 2.6% annual return in real terms. But again, that's the history. And I will get back to that because the current times in the low interest rates era, it's not that easy for bonds to make that result in the coming years. And gold, I think that gold, it's a kind of an asset class which is really touching a lot of investors, and there are a lot of discussions around gold. And what's the reality? In fact, we cannot look at gold for the last 100 years because till 1970s, gold was linked to American dollar. Therefore, gold was behaving more like treasury bills. But for the last 50 years, from 1970, gold annual return in real terms was 4.1, which is significantly less than, for example, American stocks. And commodities, they are even worse, and they are very volatile, and the maximum drawdown was very severe. For example, Goldman Sachs commodity index from 1970 was going through the maximum drawdown at the level of 87%. That's a disaster. And the risk of investing in bonds, I think, is shown here. Between 1940 till 1980, that's the period during which the interest rates were growing. The annual return in real terms for government bonds in United States, and not only government bonds, were negative. And how it happens? It's very simple. Although you buy the bonds, the American bonds, there is no risk that they will not give you money back. But there is a huge risk that the inflation is going higher than and quicker, faster than what you can get out of these bonds in terms of coupons. And because of that, when you adjust the returns from the bonds to inflation, it appears that most of them were giving the results lower than the inflation, which means that you were losing money in fact, and that was for the period of over 40 years. And I'm talking about that because from 1980 till today, the interest rates were mostly in the downtrend, which is good for the bonds, because once the interest rates is going down, the bonds you have already in your portfolio, the price will be going up because they are paying more than the new, let's say, bonds, because they pay less. And in fact, for the last 40 years, for example, the US 30-year government bonds, the return was very similar to what you could get from the stocks, but with much lower volatility. But this is the history, and that will not come up soon again, because the very low interest rates means that we cannot go much lower now, depending on the country, but for example in the United States or in Europe. And once they will go up, that means that in fact that will be very difficult time for these bonds, because if you buy a bond today and it's paying you something and the interest rate is going up, then that bond price will go down, because the new, let's say, bonds will pay more. So this is a difficult time for bonds. Therefore, you have to be very, very careful with bonds. And Warren Buffett, the great investor, said even that it should have a warning label, that investors who don't know how bonds were behaving in such period like between 1940 and 1980, they may think that there is almost no risk in bonds if behind these bonds we have, let's say, for example, American government. No, there is a risk, and this risk is bigger than it used to be in the last few decades. So, by the way, the great hedge against inflation in long term is equities. And for example, in that period between 1940 and 1980, where the bonds were really giving very poor results, the S&P 500 index in the real terms was giving 6.1% per year. So 6% above inflation each year on average. So let's go to some more details, sample portfolios. I put here some sample portfolios which you can also implement into your portfolio. And this may not tell you too much if you are the beginner, but I will show you some real example in a while. But what you can see here is how compounding works. For example, if in 1970 you would put aside $100,000 into your account, by 2020 you would get over $19 million on your account. And the annual return in real terms was almost 7%. But in the meantime, you'd have to go through the maximum drawdown at the level of minus 50%, which is a lot. So that's very, very, very tough. On the other hand, and I will tell about that maybe in some subsequent materials, you have something like Global Equities Momentum, GEM. The strategy, the active strategy which I mentioned, introduced by Gary Antonassi, which I had a honor to have on my show twice on my podcast, and his strategy over 50 years was able to make a return, the real return over 10% each year. And that's a huge difference, because that means that after 50 years, from $100,000, initial $100,000, you would have over $100 million. So as you can see, the difference between the annual return in the long term, which is the difference on the level of 1 or 2 percentage points, is really a huge difference in the long term. And I think that, by the way, this is a common pitfall to which many investors have problem, because they are very short-sighted. We overestimate what we can achieve in the short term, but we underestimate what we can achieve in the long term. And investing is more like a marathon. You should look long term to achieve your goals. And now, quickly, factor investing. I will not really go deep into this, but just I will highlight some most important facts, because there is a lot of ETFs which are so-called factor ETFs. What is a factor? A factor is a set of distinctive features which are explaining the source of the return on investment. And for example, if there is a number of factors that can affect your home valuation, and depending where your home is located, how many, the number of rooms, the living space, the neighborhood, all these factors, they affect your home valuation. And it's very similar in the financial world. We have certain factors which affect the valuation of stocks, of equities, for example. And what are factor indexes? There are ETFs which are using factors. So rather than using the market capitalization indices like S&P 500, there are indices which are constructed in a different way, and they may be weighted not by capitalization, where larger companies have a greater share in the index, but factor indices are weighted by some other criteria. And is it a passive or active approach? I would say it's definitely an active approach, although the facade of such ETF is passive, because you just buy an ETF and you think it's like a passive approach, but behind the scene, there is a magic happening, and the companies, for example, maybe the turnover of that portfolio may be quite significant and not based on market capitalization. And there are multiple different factors like value, size, momentum, high yield, quality, low volatility. And just to quickly tell you, for example, value, that means that we are filtering those companies which are having certain fundamental meeting some fundamental criteria, like, for example, price to book, price to earnings. Size, for example, we are only filtering on those companies which are smaller, so-called small cap companies. The momentum factor, on the other hand, we are, for example, then choosing the companies which are in the uptrend, which are growing, and so on and so forth. So we may apply a different set of filters on the companies, on the stocks, and build different indices and have so-called factor investing. And if you'd like to know more about factor investing, I highly encourage you to listen to my latest podcast, where I had on my show Vitaly Kalesnik from Research Affiliates. He's in fact located in London, in United Kingdom, but he's a very well-known expert having a lot of materials, papers on factor investing. So if you would like to know a bit more about factor investing, I highly encourage you to listen to that show. Rebalancing. Just we are really close to the hands-on where I show you something more practical. But rebalancing is very important to know what it is and why we have to have it. Imagine that you have a simple portfolio in which you have 60% of stocks and 40% of bonds. The trouble is that once you have such portfolio on the market is moving, and typically the stocks are moving faster, quicker than the bonds. Therefore, after some time, you may end up with a portfolio which is, instead of having 60% of the stocks, you have 70% of the stocks, and rather than 40% of the bonds, you have 30%. And that means that that portfolio looks different. There were good reasons probably for which you wanted to have only 60% of stocks, not 70, which means more risk. Hence, at some point you have to do so-called rebalancing, which means that you have to sell a bit of the stocks to make them again 60% weight in the portfolio and buy a bit of bonds to have them again 40%. And such simple operation may be executed in many different ways, but the major goal of that is to keep the portfolio in the way we designed, with the level of risk we assume to have, and therefore from time to time we have to do so-called rebalancing. And if all that sounds so complex, I will leave you for a second and I will drink a bit of tea, and I will quote words from Warren Buffett. You only have to do a very few things right in your life, so long as you don't do too many things wrong. So believe me, investing is simple, but it's not easy. And although it sounds so complex, what I'm talking about here, the real investing is really not that complex. It should be very simple. Although it's not very easy for psychological and other reasons. So let's move to hands-on. And I will show you my software, and I will make some simulation with you. And maybe I will make that picture bigger so that you can see better. So I will hide myself for a second. By the way, this is my software, System Trader, and in that software you can find a lot of built-in portfolios, over 40 portfolios made by different investors, which you can run for even over 100 years. And there are also active strategies, which I'm not talking too much about today, like Gary Antonassi Global Equities Momentum and also Advanced Equity Momentum. So basically, this is a software where you can not only use these strategies which you have here, but you also can build your own and you can adjust them to your needs. But what I wanted to show you, I wanted to talk about a particular example, how investing works in the long term. And for that reason, what I will do, I will show you a simple portfolio which is called Golden Butterfly. Golden Butterfly portfolio has 5 pieces in it. It has 40% of stocks, where 20% are S&P 500 and another 20% US small cap value. Then we have 40% income, fixed income bonds, and we have commodities, which is gold, 20%. So in fact, it's very simple to build such portfolio, and you can put 5 ETFs, and here are the tickers of these ETFs from the American stock exchanges. So if you have access to American ETFs, that's basically all you need to replicate such portfolio on the real account. And now imagine that you are in the year 1970, and for the next 30 years you would like to start with the 10,000. I put more zeros, by the way, here just to not have rounding errors. But let's say that in 1970, you put aside $10,000 and you say that you want to put another $10,000 each subsequent years for the next 30 years. And that means that by 1999, you have the capital over $2.6 million. So you start with $10,000 and then you add $10,000 each year till 1999 for 30 years. And you have, by the end of 1999, $2.6 million. That's the magic of the fact that you have the compounding working for you for the period of 30 years. And now let's say that from 2000, so you wanted to retire and you have $2.6 million on your account. So before we will go to that, I will show you how that works here. So in 1970, we started investing. We put our first 10,000 aside, and by the end of 1999, we have $2.6 million on our account. And now imagine that at the beginning of the year 2000, we retired and we have $2.6 million in our portfolio, and we want to use 4% from it till the end of our life, which means that in the first year we can take out over $100,000, and we will be doing that each year, that from the value of our portfolio we will take out for the whole year 4%. And the same portfolio, the golden butterfly. And although we were taking out 4% of our portfolio each year till the 25th of October 2021, we would have on our account over $6 million, although each year we were taking out 4%. And that 4% in the year 2000 was 4% from 2.6 million was over $100,000, whereas now that's much more, because we have over $2.5 million. $250,000 on our account we can take out each year. Excuse me just a second, I will just drink a bit of tea. It's very difficult to talk such a long time without breaks. So what you can see here is that although you were taking out money, you still end up after the 22 years more money than you had at the beginning. So that's the magic of the markets, and that's the magic of the compounding. Obviously now the portfolio is not going up so nicely as it was in the accumulation phase, but when we are withdrawing money each year from the portfolio, that equity line is not growing so quickly up, but still after 22 years we are having more on our account. So that's the magic of compounding and the magic of the markets. And I'm talking here about the passive portfolio. It's not an active strategy. And just last thing I wanted to show you is that was in the American dollar. But imagine that you are in Europe and we are having euro currency here rather than American dollar. Then if you are investing such money and you are calculating it to the euro, it will work differently. So it's very important to know, because having the exposure to American stock exchanges, to American stocks, and having the exposure to gold, basically that means that over 50% of your portfolio, and here in that case even bonds, so basically 100% of the portfolio was in American dollar. That means that we the investor, which is not located in United States, has a huge exposure to other currency. So that's important to know that. And probably someone from Europe would like to have in such portfolio also other assets which are in euro currency, so that to have a lower risk coming from just the currency like American dollar. So just to mark that, although in that first case we had $2.6 million in 2000, and at the end $6.3 million, if we would have 2 million euros in the year 2000, at the end of the simulation in 2021, we would have 3.3 millions of euros. It's less than when we would have that in American dollars. The rate of return, the compounded rate of return in the case of American dollars was almost twice bigger than in euro. So just to highlight you that you should consider such things. And with that software, it's very easy, because basically if you take any example of the portfolio, if you click edit, you can easily change the currency here, so that the application will show you how that works in expressed in a different currency. And by the way, in that software, apart from the fact that you have over 40 ready portfolios, you have also access to the data, to the latest data, so that you can see how these portfolios are working in the real time. You can monitor such portfolios, and you have access to over 70 stock exchanges worldwide. So basically, you can find here anything you can imagine, not only ETFs, but also stocks, indices, currencies, cryptocurrencies. So basically anything you can imagine. And also on top of it, you have the built-in historical data, which is allowing you to go back even to more than 100 years back. So you can check your portfolios for a very, very long period, like 50, 80, 100 years or even more, to see how such portfolio was working really in the long term. So I really highly encourage you to give it a try, because that's very important to do our homework. And with such tool, you can do it really easily and quickly. So I think it's very, very handy. Okay, so let's go back to our presentation. That was a quick show of the software. And if you would like to see how that software works more in details, step by step, I can organize another session where I could show you how we can build such portfolios step by step, and how we can test it, and what conclusions we should take out of it. So let's make some summary. Any asset can experience huge losses, so we cannot depend on just one asset. We cannot just put one company to our portfolio, or even one country to our portfolio. We should have a very well diversified portfolio, and with some uncorrelated assets. So for example, if the stock market is going down, the bonds will go up, or maybe the gold will go up at that time. So we don't put all eggs into the same basket, as they say. Another thing is that we can consider using factor investing, like for example, value momentum. So I'm not a big fan of factor ETFs as such, but I do believe that factors work. But you don't have to do it only via ETFs. You can do it by yourself. And for example, momentum. The great example is shown by Gary Antonassi in Global Equities Momentum. So definitely you can consider using factors in your portfolio either way, either through ETFs or do it via your own strategy. but this is the way to go if you want to improve the returns in your portfolio. Another thing is that once you have built your strategy, you have to stick with it. And it sounds simple, but it's not that simple, because it's very easy to see the results of a strategy long term and you know the end result, but each strategy, even the good strategy, has the periods of underperformance, and these moments are very difficult for the investor to go through and to be disciplined. But this is the way you have to behave. I mean, you have to stick with your strategy even in the poor times, when you are losing money, because this is the only way to capture in the end the premium for the risk you're taking. And paradoxically, just because the strategy is having difficult periods, that's the reason why you can capture the premium, because not everyone is willing to accept that risk. So you have to accept that risk to be able to get reward for taking it. And don't forget about fees and taxes. Really, I mean, the fees and taxes, as I said, you cannot control the markets, but you can control fees and taxes being paid, and you should make them minimum as possible. And at the end, once you have your portfolio, just live your life. I mean, it's great that you have a strategy. It's great that you came up with a great approach for your portfolio. But then that doesn't mean that you have to every day spend time on your investments. Just live your life and let the market do the job, let the strategy do the job. And strategies like the passive investments or like global equities momentum I mentioned, they don't require us to log into our account every day. We can do it monthly or even less frequently, but we have to stick with it and we have to go through it with discipline. And who's the biggest enemy of our investments? Well, in the morning, just look into the mirror and look at the person you see on the other side, and that's us. And in fact, we are trying to find enemies on the markets and the big problems there for our portfolio. But in fact, the biggest problem in investments is us. It's a kind of a game with our psychology, with our weaknesses. So you have to be really, disciplined, and you have to understand that we are trying to be overconfident. We think that we are better than we are. So I think that we should be very skeptical about our skills on the market. And it's better to follow a simple strategy rather than think that we can be smarter than the rest of the people on the market. And now, quick commercial, because I'm selling the software I mentioned to you, the ST software, which I showed you here for a second today only. If you would like to really do your homework and to apply the knowledge I was giving you today, then I think that this software is really a great way to go, because for just $179 for 1 year or $299 for 2 years, you can get license to that software. And what you get buying that software, you have over 40 portfolios ready-made, so you can use them. You have also 2 active strategies, which I haven't discussed today, but the GEM, Global Equities Momentum, by Gary Antonassi, and Advanced Equity Momentum. You have also access to the historical data going back to 120 years, which is, I think, exceptional, and you cannot find this easily anywhere else. You have also access to over 70 exchanges worldwide. So you don't only have the possibility to backtest the strategy on the historical data for the last 100 years, for example, but you can also monitor that portfolio on a daily basis. for example, make the rebalancing or to generate the signals if you are following the active strategy. Then once you buy such software, you have the priority technical support. So basically you have access to me, and wherever you have a problem, how to use, or you don't know how to do something in the application, you can write an email to me, and you have a quick answer from me. Then you have the fixed price guarantee, meaning that if you would like to renew your license in the future, you will have the price you are paying today. And also you have the lowest price guarantee, meaning that this price you can see today will never be lower. Never. I mean, I will not give any discounts. It can only go up, and it will go up by that price from December will be the price you can see here. So only now you still have a chance to buy this at that price you can see here, and that price will never return. And you have latest updates, meaning that if you buy the software, once you have the license active, the software is being constantly developed, so you get access to the latest version. So really, I really highly encourage you to visit my website at systemtrader.show/shop and see the full offer. And just give me a second to drink a bit of tea so that I can help my voice for a bit. Okay. All right. So let's go further. And we have questions, and I have a question from Octavian. And Octavian says that a quick analysis of buying an ETF with the ticker VWCE every month using some brokers available in Belgium. Net value after 1 year. Okay, so what Tavi says, I believe, let me look at it. Is that there are different net values after 1 year for different brokers. But Tavi, I don't understand exactly what is your question. Okay, here the difference in taxes is staggering. Why? Well, I'm not sure from where you took these values, because the taxes as such are not different just because of a broker. The taxes are dictated by your tax residence, so it should not matter if you are buying a given ETF in one or the other broker. What does matter is that you pay taxes where you are located. And also, just to be sure, the same ETF may be expressed with or without, for example, dividends. I don't know if that particular ETF is distributing dividends or it's accumulating them. But basically, it's not the fact where you buy the ETF. The only difference you can see is that you pay a different commission, for example, but the ETF value, I mean the investment as such, will not be impacted depending on where you buy it or which broker. So what I suggest is that just please drop me an email, and I will get back to that, because it's really hard to tell me something more on top of that. But I just want to assure you one thing. The given ETF is listed on a given stock exchange, and the broker is only a proxy where you can buy it to that stock exchange. It's not the broker who dictates how much, for example, taxes you will pay or not. So that's for sure. And as I said, just please drop me an email so that we can discuss it further. So sorry for that, but it's very difficult for me to address that question in details now, but I'm pretty sure we will clarify via the email. Okay, I think that that's all for today, unless you don't have any other questions. Thank you so much for being with me. It's 1 hour and 40 minutes already, so that's been a long time. And if you'd like to have more material on that, especially with some practical aspects, with more hands-on, please drop me an email or put some comments so that I can organize that in the coming weeks. And also, please do remember that only by the end of November you can buy at systemtrader.show/shop my software at a very attractive price, and that price will go higher. So therefore, really, if you want to do your homework right, I think it's really a great price to pay for, and it's not a high price to pay for the homework, which can serve you for the rest of your life. Okay, thank you very much for your time. I wish you, I don't know wherever you are located in Europe, it's very late now, so good night. But if you are listening it during the day, so have a good day and take care, and see you soon. Bye-bye.